Hello and welcome back to the Growth Circle podcast. My name is Lincoln Amstutz, and today I've got a friend and guest on, Nick Farquhar. Really excited to jump into this interview here. A little bit before I bring Nick on, give a little info on him. Nick is a 24-year-old commercial real estate investor and tech entrepreneur. He is building the future of apartment complex portfolio management and intends to disrupt an untapped market nationwide. Nick is growing a personal portfolio of rental properties and is acquiring hundreds of units under his management company. And today we're going to be diving into all of that. So Nick, welcome on to the Growth Circle podcast.
Yeah, thanks so much for having me, Lincoln. Really excited to dive in.
Definitely. Well, you got started in real estate in a relatively short time ago, just in the last couple of years, yet you've scaled your personal portfolio to over 114 units. And your company is managing right around 300 units. How have you been able to scale so fast? And what has been your mindset in taking off with this rapid growth?
Yeah, absolutely. So I think that the thing that really catapulted me was trying to focus on the network good of essentially asset management. So starting to build in construction, or I built a construction company at first, and then built deal flow, built management, kind of built the entire thing so that I could outcompete others and pay a higher price on an asset because I could turn it around faster and cheaper. And then I think that the other big thing is I'm super in the weeds on underwriting. So I really understand the commercial real estate value equation. And I think that's a huge piece of the equation if you're trying to add value to properties.
Absolutely. So you started out kind of having that background construction side, got good at analyzing these deals and really being able to dive in. And because of some of these skill sets that you developed, you were able to get into better deals and, take things down that others potentially, wouldn't be able to, it sounds like. What markets are you in currently? Maybe where did you start? What are you in right now?
Yeah, absolutely. So I'm in Columbia, Missouri, primarily. I think I have slightly over half of my portfolio there. However, my most recent and largest acquisition was in Kansas City, Kansas. So I'm a huge fan of low-income housing, or as I like to say, workforce housing type properties, as I believe that you can really build the biggest delta in how you're treating the community and start to really build in kind of the network go to people living next to people they want to live next to, and then you can make that snowball move in the opposite direction than it normally does in these low-income housing areas. So,
yeah, I like that. So you said kind of workforce housing. Is that something that you'll specifically look for in the deals that are coming your way and brought to your play? Do you see, one, a lot of value that you can add to those potential tenants, but also, potentially a larger profit margin because less people are interested in those types of assets?
Yeah, absolutely. So it's a hard asset to do really well. It really is. You have to not only be good at asset management, but you also have to be really good at people management. And I think it scares a lot of folks because there's so many unknown unknowns when coming into kind of a distressed area. But I found that industrial areas with kind of B class, B minus class probably MSAs, and then maybe C class properties and D class communities are really what I aim for, because I believe that if you can come in and just put really good anchor tenants in and kind of make sure that the top 25% of tenants feel like you're building for them, you end up attracting better and better tenants and therefore build a better system for everybody. So I think there's a lot of opportunity within these types of assets, but it's certainly not for the faint of heart.
Right. No, I'm sure it takes quite the management system to be able to do that well, and all around for the tenants, for yourself, that it is a win-win there, and that growth. I kind of want to maybe back up a little bit. So when you, like you were saying, you got started with some of this construction, can you bring me into a little bit of that? What your experience was on that side of things?
Yeah, absolutely. So I grew up, my dad owns a window distributor. So I grew up doing a lot of window install and was kind of around the blue collar side of things in construction for a very long time. That was always, my summer job and whatever was helping the crews there. So when I was in college, I had a power washing business that I built to like low six figures, and then kind of use that as my into deal flow, because I would, clean portfolios for landlords for half off or free for lunches and deal, or opportunities to get on and see deals. And then I kind of took that entire company and transitioned it into a rehab company when I got my first deal, because my first deal was gross. It was like, black mold everywhere, needed basically down to the studs, full reconstruction. And so I was able to kind of drive a ton of value there just by, frankly, being young and dumb enough to do a deal that nobody else was willing to. And so, yeah, the construction company helped a ton there on that deal and then the next few and into today.
Got it. Kind of on that note, yeah, with being young and going for it type of thing, sometimes, things that other people might not, jump into because you just haven't had that experience and you haven't heard all the people saying, oh, always this, don't do that. You're just running for it. Do you feel like that's helped you more with your growth over the last, couple of years, or has it been a hindrance in getting into situations, it's harder to get into situations or deals that you maybe could have if you were older? What do you think on that?
Sure. So it's a bit of a complex answer. I do think it's helped me a lot starting out with kind of the ugly duckling deals, because it's made me a lot less fearful of other properties that a lot of people have turned their nose up at that I've made a lot of value in. But on the other side of things, I think that it has also made me, potentially undervalue the stability of low risk. And so that's kind of the transition I'm going through right now, is I'm going from kind of these D class, D plus, C minus type properties into C plus, B minus type properties, as I finally have, kind of the capital stack and the skill set in order to get into these types of deals. So while I think it was really helpful for me starting my career, I don't know necessarily that fits the overall ethos of what I'm trying to build moving forward. Because really my whole portfolio vision is I want to supply very affordable, high value housing to the everyday man of America, because I think that that's never going away. And so, but my definition of what that is has probably shifted.
Right. I think that's a noble vision, and something that, you can get a team behind as well on providing that affordable housing, because at the end of the day, more and more people are renting and moving to these apartment type of properties. And so you being able to provide a good service there is huge, and it's going to be something that's needed for years and years to come, is only increasing. So I like that's your focus within this. So with the, you acquired some properties, did you start out with hiring a management service to take care of those, or have you always managed your properties? How did that get rolling?
I did. So ironically, given what I'm building now, I always said I never wanted to be a property manager. It seems like a pretty terrible gig in general. And frankly, myself personally, it's not what I'm great at. We build a great system, but that's not my skill set. My skill set's all around deals and construction and project management. So when I was getting started very early, like after I bought my first duplex, I passed off management for the first lease to a property management company so that I could focus on deals and kind of growing the portfolio. But obviously that's changed slightly or considerably since then, as there were quite a few issues with working with the average property management company if you are trying to build a very aggressive portfolio of multifamily.
Got it. So you got into it, primarily because you're interested by the deals, right? And I can honestly say the same for me. Like, I like analyzing the deals, trying to figure out, putting all the puzzle pieces together of where to get it, the financing, the construction, what's our exit, what's our long-term plan. So that, I definitely get where you're coming from on that end. But it sounds like the management was, once you got into it, you realized, okay, this isn't maybe done to the level that I would like it, the quality, my expectations aren't really being met. And it's my understanding that you have really dived into that and work to create your own, management and even software. Can you go into some of that?
Yeah, absolutely. So when I was getting started working with a property manager, I think the biggest issue overall was that they were kind of juggling commercial clients in the same way that they were juggling single family owners. And obviously the way that you drive value is very, very different within those two worlds. It's almost completely different industries. The way that you drive single family values and the way you drive commercial values is completely opposite. And so when I was getting started, what I found was not only could I not really track what was going on in my portfolio, but my operations partner, my property manager, wasn't very incentivized in the same way that I was to get my property to pro forma. I felt like they were kind of nickel and diming me on fees, turnovers, whatever. And so we started building Appreciate about a year ago, which very simply is a multifamily asset management company. So we handle the operations. And then we're also building portfolio management technology. So making it really easy to understand where every dollar is going, every piece of risk, real-time updates on portfolio status, et cetera. Basically the things that I was spending like 2 weeks a month just trying to aggregate from monthly PDF statements from AppFolio and stuff like that. It's really hard to maneuver a business, which commercial real estate is a business, not an asset, right? And I think that that's one of the most fundamental things that I realized about a year ago in driving value. A single family is always going to be an asset. You can't really run it like a business unless you run an Airbnb out of it. But these multifamily assets are valued based on the annuity of cash flows that are created from it. And so we basically have been trying to build the operations team and stack that kind of aligns the manager's goals with the capital partner's goals, and then make it really easy for everybody to work together.
Got it. Okay. So you're doing a bit more than just, the traditional management on these types of properties. You're incorporating some technology into it and opening up a lot more understanding and metrics of what's really going on with these properties, which is huge because, like you said, these commercial type properties, multifamily apartments, whatever it is, they are businesses in and of themselves. And, if your property manager is the main, backbone of the operations and the one that's collecting the rents and facilitating all of these things, then you want them to be as outfitted as possible, have plenty of resources to manage that business well and to give you insight into how it's doing, rather than you as the owner having to go through and doing all that. So what are you providing? Can you give us a little info on Appreciate and what you're building out to open up more metrics there?
Yeah, absolutely. So there's two things that we're doing. So one is kind of what we're doing today, and then the second thing is what we've raised money on. So we've raised 2 rounds of venture capital so far, so that's obviously a different world than real estate, and kind of conflicting in a lot of ways in kind of the groups you're talking to. But what we're doing today basically is I mentioned the idea of alignment of incentives when working with operations partners within commercial. And so basically what we're trying to build is a company that is closer to a portfolio management company. So is aligned with you and your goals of growing your portfolio, making it really easy to do so. And then also directly tying our compensation to net operating income, which is the most important metric within commercial that you can really impact. So we've built a lot of tech around basically understanding where money's going and then understanding risk. But what we've been raising money for and what we're building currently is essentially a portfolio management platform. So all of the different players that you currently handle as the owner, so the mortgage, insurance, capital partners, IRS, whatever, that you have to deal with, that you currently have to communicate with your manager to get data that's, kind of a month lag, bring it back, and now you're holding the data and you go out and you try to explain to all these partners what's going on. We're trying to centralize that on Appreciate's platform so that when you're interacting with each of these players, not only are you interacting with a much broader group of them, but also making it far easier to manage the communication and transactions with each of these people so that as you scale, it's one less thing that you have to have a headache about. Because today, property managers, it kind of stops at collecting rent and stops at maybe construction, right? But there's so much more to the business of commercial real estate. And so we're really trying to give like almost a syndication-esque asset management experience to individual LPs that own individual properties outright. So there's no asset management company that exists for this kind of sub-institutional 25-unit apartment complex because it's just too small, for a lot of these guys. But tech now allows us to bridge the gap between assets and kind of look at the entire portfolio holistically instead of just individually, if that makes sense.
Okay. So something that may have only been available to these large apartment complexes of hundreds and hundreds of units that, have full-time staff and people that are a part of this one particular property, that all around, all encompassing property management, like you say, from the turnovers in construction to all of the financial breakdowns, not just the maintenance costs or just the rent collection. You're talking taxes, insurance, mortgages. Like something that was once maybe just available to these large properties, you are able to, utilizing technology, make that available to a 24 unit or more mom and pop size apartment building for that terminology. So is that what it's essentially allowing you to do, is bring that all-encompassing management that a lot of property managers, probably most, miss out on? You're able to bring that to people in a better package?
Exactly. Yeah. Property management and asset management. You can almost think of it as, property management is within asset management. It's one of the things you do, but we're essentially trying to expand what that looks like and then be directly compensated only on increasing asset value. And so the idea is kind of long-term, there's a steep drop-off in valuations of properties when syndications can start playing there, right? So when they have like the economy of scale to have on-site maintenance and management, all of a sudden people are willing to pay like 30% more for that same income, right? So what we're really trying to do is make a frictionless experience for the capital that's invested in these 30-unit apartment complexes. So it's far more scalable, because today it's really hard to build up a large portfolio of middle-sized multifamily. Eventually you just kind of graduate up into the big stuff, but now you're paying much higher price tags. And so we're trying to essentially raise the overall valuation of this financial product by bringing asset management downwards and being the technology company that allows that to happen. And so, yeah, I don't know if that answers all of your questions, but
yeah, no, that's it's neat. It definitely is. It separates yourself from these other property managers, right? It shows that, it's more of an asset management and increasing the overall. You are specifically helping the owners increase the overall value of their property instead of just managing the property that they own. And
exactly.
I guess my, question on that would be, are you then, somebody brings you a property, you're now entering in and helping, save them money, raise that value? Or are you even selling some of these properties to, potential buyers and then, continuing to manage it?
Yeah, absolutely. So we're doing kind of all of the above. So we've moved assets in both directions, buy and sell. We've built up quite a bit of deal flow as well. And we've worked with private equity and multiple times to go take down these assets. Because at the end of the day, multifamily is a financial product, right? So if you can just build a better system that can turn these assets around more repeatably with less friction, then it's not hard to find capital. It's much harder to find a deal. So we've really leaned into that side of things. But yeah, no, you're completely correct in our approach. We're trying to be very holistic for the owners that we work with. And honestly, it's a pretty small group of owners that we work with very intentionally, because we want to work with people like what it sounds like your podcast is exactly aiming towards, which is very high growth owners. The unfortunate reality is not every real estate investor thinks the same. And generally, if you're very high growth, you tend to end up in commercial. Not always, but most of the time you do tend to end up in commercial, because the commercial real estate equation is so powerful. And so that's why we've chosen this asset to be our horizontal, and to aim as much as we possibly can at turning these types of assets around and being the best manager for this particular niche type of property across the United States.
Where would the property ideally fall in line with as far as size? Is it something where, hey, as soon as it's multifamily at 4 units, this works great? And is there a cutoff at like 100 units? Like, okay, we're not adding a ton of value there, or is it more than that?
Yeah, so it's basically from the bottom rungs of commercial, so anywhere from 6 units and above, depending on the state. And the definition of commercial is literally how the bank will underwrite it, right? So is it based off of comps, or is it based off of revenue and net operating income, depending on your state again? And so, around here in Colombia, it's around 6 units where the bank will start looking at net operating income to underwrite instead of looking at comparables. And so that we will go all the way from that bottom rung all the way up into the highest sub-institutional level. So the largest asset we manage right now is 51 townhome units. So it's like 43,000 per month in revenue, something like that. And really our cutoff point is where we start competing with institutional capital that can invest anywhere in the nation. So the difference between, let's just say hypothetically, 100-unit apartment complex is big enough to have maintenance and management on site. Somebody in Delaware can be investing in that asset and just build an entire business on site. It's large enough to be its own island, but hypothetically that 99-unit apartment complex maybe is not big enough in order to have 2 or 3 full-time staff on site. And so all of a sudden the demand goes down extremely at that level. So we're trying to fill that gap where we can be the third-party asset management company that allows true partnership between our capital partners and ourselves, so that we have all the same incentive structures. We're all being graded off of the same things, and we fundamentally are essentially business-to-business property management, if that makes sense.
Got it.
But that's our range, small all the way up to wherever we're starting to compete with the gray stars of the world. So
Makes sense. Now, I mean, for this product, when you're specifically running these metrics to help improve the value of properties, not just the management, and more all-encompassing, to me, it would sound like a product that's more of a premium product that you are able to charge more for. Does it end up costing owners a little bit more to work with you all in this way? I know that, in some ways it may save them money if you're basing it off the NOI. Like, how does that break down for an owner?
Sure. So, yes, we are a premium product. That being said, we also have the luxury right now of having quite a bit of venture capital that helps us subsidize and be price comparable to other property managers. So currently, we're able to give a far better service at the same or oftentimes lower price as our competitors because we're playing unfairly, frankly. We're able to raise venture money, pass that on to our owners, and help them grow their portfolio with kind of everybody's aligned goal of the better you do, the more assets we manage, the better we do, better you do, and trying to get that flywheel where we're all kind of working on the same team. That being said, fully transparently, down the road, we certainly will be pricing premium because, even in the last year, we've driven 1.5 million in capital gains across about 150 units that have had a refi or any kind of an asset sale or anything like that. So at the end of the day, the most important thing is a property manager is an expense line item. An asset manager is the single best partner that you could have, because within commercial, operations is the most important thing for driving value. And so that's why we're really positioning ourselves on the asset management, portfolio management side of the aisle, because we want to help grow the portfolio and get proved for the value get paid for the value that we can prove, basically. And we only get paid when we create that value. So we will take a larger piece of that pie, but also we're able to make that pie, considerably larger, considerably quicker. That's the goal.
Yeah. I know there's a technology aspect to this and a system and software that you're building out. What does that look like? Because it's, you've got your appfolios and your other management softwares. My understanding, you're not using those, you're creating your own.
So we actually do use something called Door Loop for our property management software. So what that means is, imagine there's 3 main players here. There's the asset itself, there's the property manager, and then there's the owner, right? So if it's in a line, the property manager works with the asset, and then the property manager works with the owner to give information back and forth, right? So what we're really trying to do is not compete between property or asset and property manager, but we're trying to compete between property manager and owner on the tech we're building. So it's all about communicating what is going on in the portfolio and also connecting all of your partners that currently you are manually connecting with through like email or going to meet at the bank, right? Or basically the hyper in-person and super non-scalable partnership management side of things is what we're really tackling. So the way we're trying to build it is asset goes to appreciate. Appreciate is a central module and command center, if you will, where each player, including yourself, any of your business partners, whatever, can interact with the data of the asset in real time. All inspection data, all risk data, all financial data. And then you as the owner can very easily work with the same center or a source of truth with all of these different people, see what's going on in real time, and make decisions that are not only faster, but are, backed by actionable data.
Yeah.
And so that's really where we're competing. We're not trying to build the same wheel that everybody's built a million times and, just trying to manage the property better. Frankly, that problem's been solved. What we're trying to solve is the problem between us and those we serve.
Right. That makes sense, because I know even for me, right, maybe the property manager knows some more of this information on, the behind the scenes things that are happening, that, they're documenting these extra costs on maintenance and maybe, late rent payments and, hey, that's still got to come in. Maybe they have that information, but I don't know it. And I find myself often having to reach out to the property manager asking these questions, and then they got to go back to their system. They've got it a lot of the time, but then they're, it's this communication issue versus what you're doing. It sounds like, you're eliminating a lot of those problems. By utilizing technology, you're able to track all of the different metrics very well, very clear, and then give the owner ideally a lot of that access so they can see these metrics without having to constantly that back and forth asking of the manager what's going on.
Exactly. And one of the things I want to hit on is, so I'm a total nerd when it comes to my numbers. I probably know my numbers better than almost anybody because I'm very in the weeds. Because if you don't understand your data and the direction your portfolio is going, then you can't make the correct decision. And the only thing worse than making the wrong decision is not making any decision, right? And so it's very important to be on top of it. So what we're trying to build, like very simply, what your dashboard looks like is you're able to see all your vacancies, see all your operational data, see your net operating income over time, and most importantly, it's trend analysis, right? So being able to see what your expense ratio is doing over time, or what your loan to value is doing over time, or what is your DSCR today, or how much money are you making in principal every single month? Because that changes with amortization schedules. Where is my insurance documentation? I need a new mortgage on this. I've got to go through 8 different channels in order to get any kind of bid. Whereas it should be, I click one button and all the underwriting information already exists, so people can come bid on it, or banks, lending institutions can come bid on it, and you just basically control your portfolio from one spot instead of having to manage all these relationships in a plethora of different non-scalable ways, but you can manage them all in one spot. Because at the end of the day, real estate, is any good real estate investor will say and knows, is a collection of relationships. And today it's super hard to actually manage those because you're all speaking different languages and you're all working with different information. Bank A doesn't know what Bank B is underwriting on. They can't see into each other's portfolios. Lincoln, if you and I wanted to buy a property together, I would hope you'd want to look into my portfolio, because I would certainly want to look into yours. Because if that property starts going poorly, then I want to know that you have some ammo in the tank to help me fix the problem, so I'm not left fixing it on my own, right? So we don't both go down. And that's the whole idea, is if everybody can underwrite easier what's going on at all times, you can make that buy decision, that sell decision, that refinance decision, that partnership decision far easier. And that's what we're trying to build.
I see. No, and it's filling a gap, right? It's something that is just not, at least in my experience from what I've heard, available, but it just makes so much sense of you are working alongside with these owners so much more. And yeah, you've been getting these bits for insurance and allowing bankers to talk with one another, to look more closely at a portfolio of what somebody has. And there's just so much value that gets provided there. And it's really the way it should be done. And, you're going to benefit because as a manager, with your clients are making more money and they're, seeing things the way that they need to be seen. And they're like, okay, we need to put some more money into this property. Okay, this property is making good money. We can utilize that to go and buy something new. Now you are going to get to manage more properties and work more efficiently with your owners as well. So it's a win-win there. And I think that you're definitely jumping on something that needed to be done. So when it comes to, we talked about it is kind of a premium product, but at the same time, you're saving your owners money, adding all this value. Is there a percentage, like a 10% management type of fee, or how does that break down with the way that you set this up?
Yeah, so we don't charge any gross fee, so nothing off the top. Most property managers charge like 10% of top line, and that's what they'll tell you. And then where they actually make a lot of money is on like marking up construction, taking 30 to 50% of the first month's lease, which more than anything, it's kind of annoying because obviously it's not told that it's part of their fee. But the biggest issue is that it incentivizes them to maybe have unprofitable construction and not really care about the return, right? Or potentially to keep a tenant for 2 years instead of 4, even though they might have paid the renewal or they may be the best tenant, all things considered. But for the manager, that 30% of that first month's fee is 3 months worth of revenue, right? So how we charge is we don't charge any fees. We don't mark up any maintenance. We don't mark up any labor. We don't mark up any construction. Where we make our money is as a percentage of net operating income. So for the single families that we manage right now, we're charging 15%, and we're only managing single families for very high growth owners who it's a piece of their portfolio just to make it easy for them, but it's not our target. Our target multifamily, we charge 19% of net operating income, but that ends up shaking out to about 10% of top line, because after the maintenance expenses for the month, the insurance, tax, and depreciation expenses that we allot for, it ends up being about 60-ish% of top line revenue. So we're taking a higher percentage of a lower number. But the most important piece of that is in the commercial valuation equation, it vastly incentivizes us to make that net operating income number higher, because that's the only way we make money. If the property is in a losing money state, we don't make anything, right? And the more that it makes, the more that we make, which if you're in multifamily, honestly, one of the things I really like saying is I look at cash flow defensively, not offensively. Capital gains is the offense. And the way that you drive capital gains is through driving net operating income. And so we're trying to align ourselves as closely to that as possible so that we can make, the owner $12 for every dollar of net operating income, if that makes sense.
Absolutely. Yeah. So you're tying yourself to the owner, right? Like if they succeed, you succeed. If they are having bad months, you're going to have some bad months. It incentivizes, you to do everything you can to help this property. And again, it goes to that, focus that you're having is improving the value of these properties and helping out your owners. And in turn, that's going to help out the tenants that are in these properties, because you're going to want it managed well and you're going to want things to get taken care of. And, for tenants to stay long time, you are trying to get good tenants, all these things, it's a win-win instead of the maybe classic or, the setup that it's been for a while, these managers not having the same goals and alignments as the owners, right? Like you're saying, they want to maybe get a tenant in there that is going to be gone in a year or in 2 years because they make more on those turnovers. And then they get their crews in there to fix it up and make, charge 20% on the actual cost of that turnover. All these things that it's currently done in 95, I'm sure, percent of property managers. You're changing that up so that it's a win-win on both sides.
Exactly. Yeah, I would say the best way to describe our customers, they're a winner. So they're not the people who don't have the ability or desire to grow. They're the true real estate professionals who understand what's going on. And frankly, we're an alternative to in-housing property management. That's really where we come in. We're not for the guy with 2 units that they inherited from their grandma. Like that's our model doesn't necessarily align with 1 or 2 single families. The tech we're building isn't for small portfolios. What we're building is for people who own 40 units who'd like to own 400, and that's really what we're trying to do and what we're trying to build for.
Can you go into a little bit on building out the tech? I mean, do you have a background yourself in technology, software? I mean, that's got to be quite the undertaking of putting all of these metrics together. Just that process in and of itself.
Yeah, no. So I have no technical background when it comes to programming. Where my technical background is, I would say, is like economics and finance and commercial real estate nerdism. So I'm very familiar with like what metrics we're looking for, what is most important, because it's obviously there's a lot to learn always, but the metrics I've been tracking, I think, are probably the most important thing for growing my portfolio efficiently and as quickly as I have. And so from a data science side, it's not that hard. But from the building tech side, so we have a full-time CTO, and then my co-founder, Brad Siegler, is technical as well. Brad is very, very familiar with building in this weird space that, frankly, private equity is like, why are you doing VC? And VC is like, why are you doing private equity? Because he built Equipment Share, which is a $5 billion vertical construction tech company that basically is taking the exact same approach as we are within multifamily on the job site. And so they're building like a lot of tech around tracking the job site, its efficiency for construction, and basically helping their customers become the best customer ever because they just keep reinvesting, right? And that's what we want to do too, is we want to build a true white glove service and kind of go that route. But yeah, that's who's been building our tech. We're about to raise our seed round right now. And in our seed round, we're aiming to either triple or quadruple our dev team as well going into Series A.
Good. Go into a little bit on the raising capital side of things, because, I know a lot of investors that, you can raise private capital for a deal at a time, right? A single family, a flip, maybe in a small multifamily project, or, a few at once. But I mean, you're taking down large, multifamily properties, multiple at once. What has been your strategy for raising capital?
Previous deals. Honestly, at the end of the day, none of the tech matters if you don't hit your metrics. If you don't produce a better ecosystem for the property to make more money, nothing else matters. And we're not naive to that. And so the best way that we've raised money so far has been pointing to deals that we've already done and where we've turned stuff around. I mean, from that end, it is a private equity play, right? At the end of the day, people only care about tech if it makes you more money. And so the point is, what we're building directly makes you more money. And so that's been our number one thing. Frankly, we don't have any issue with capital. We probably have 8 or 9 capital partners with very, very deep pockets that are trying to take down every deal. Right now in this economy, our bottleneck is deal flow. And so finding the right deal that works and is in an area that we service, that's been kind of the hardest piece. But we've found that the best customer is not somebody you have to convince to work with you. It's somebody who's already worked with you, who you've already made $800,000 for, and now wants to go buy the next property and do it again and again and again. And so our bottleneck's on the property side.
Does that come pretty naturally to you, the networking and making connections? Because of course, working with people you've already done deals with is great, but it had to start somewhere. Is that something that just came about pretty naturally? You getting around and shaking hands and talking to people early on. How did that start for you?
So honestly, I would say I'm a terrible networker. That's not one of my skill sets. I know for a lot of CEOs that is a huge skill set for them, but I'm certainly closer to a product-led CEO when it comes to. I didn't raise money. I didn't really shake my hands into deals. I took down a few deals. I did a really good job, and then I pointed to them for raising money after that. I believe that at the end of the day, results are what matters. And so if you can just drive results and point and say, basically all that money is or it's all just looking for a good place to harbor, right? Where it can make the most return on investment. And that's what private equity is looking for. And so most of our growth has been essentially PE driven and VC supported, if that makes sense. So it's been really beneficial to kind of lean the two against each other, which I think is our largest advantage against anybody on the private equity side or the VC side. We're not naive to what needs to be done, but we also have the chops to take deals down. And so, the number one thing that helped spur my personal growth in my portfolio was just slowly escalating deal size and repeatedly bringing returns.
Mm-hmm.
So
yeah, it's a lot easier to get somebody, on board with what you're doing and sell when the product speaks for itself, right? The results are there. You've made money. It's been a good deal, success, rather than having to sell somebody on a deal or raising capital when, it was kind of like a halfway deal or didn't quite go. I mean, you're letting the results speak for themselves and letting that be the driving metric. And that should bring more people in, right? Like if somebody is looking to invest money and, you're working with them now, likely they're going to go tell their buddy and their friend and, who's doing something similar, and that network will naturally spread just because you're nailing the part that you're working on yourself. And so that, that's got to be the focus. I think what you're doing there makes plenty of sense. How is your, and go ahead.
Oh no, you're totally fine.
I was going to say, how has your focus shifted? Because I know you got into, real estate for growing a portfolio. That's kind of what you like to do is getting in and vetting those deals and growing that. But then it's shifted, substantially, it sounds like, to this management software in your management company. How do you split up your time now? Is there one that has a lot more focus than the other, or is it just balancing both?
Yeah, so I mean, it's all really one and the same. The tech that we're building, like I said earlier, is just trying to make the operator better and trying to make it better for me as the owner. Really, I started building Appreciate because it was the operations product and team I wish I had, that I was kind of envisioning. And so we just decided to start growing that. So I spent a lot of time talking to investors, leading the team, working on product to a certain extent. Obviously, I'm not technical, so it's mostly point and shoot stuff. But at my core, I'm a private equity guy. I'm not really a VC guy. Don't tell my VC investors, but while I enjoy the VC world and it's incredible what you can build with that type of support, I believe that there's a huge disconnect, particularly within prop tech and real estate, between VC and actually building value. There's a lot of naivety. And so what I really enjoy doing is just being super down in the weeds on the project management side. And I'm building the tech to try to help the project management side. But I spend most of my time working with our customers' deals and my personal deals, and then basically bringing that feedback back to the team that's really building the tech and trying to lead from the front lines of what is it that our owners want and how can we serve them better. And the nice thing about kind of our, we have a very short list of owners that we work with right now. And that's largely intentional. And one of the biggest reasons we want to do that is we want to hyper focus on the niche that we're aiming for, which is super high growth, multifamily owners who want to eat the world and then build specifically for them and not get bogged down with basically the people we're not building for and the properties we're not building for. And so I believe that just by staying as close to the deal and as close to the relationship as possible and just trying to hear the customer, that's the number one thing that I could do as CEO of this company to really build a product that people need.
And I'm sure that has to be difficult to keep that focus so pinpointed on, knowing the people that you want to work with and just narrowing that down so much, because when you provide value like this and, you are successful with your own properties and, you're being successful with other people's, naturally you're going to have homeowners and landlords and such bring you more properties. And like you're saying, you don't really deal with a lot of single family type of units. You will if potentially that owner has some extra on the side of their multifamily. But how difficult has that been, to maybe stay pinpointed and be that focused?
Immensely difficult. I mean, last week alone, we turned down about 120 units of single family, which when you're in VC, the number one thing that matters is revenue, right? And so one of the guiding ideas of kind of ZERP over the last 10 years within tech has been do things that don't scale, revenue at all costs, and we're taking a different approach and we'll see if we're correct. But the way we're trying to approach this is we want to be the most white gloved, laser focused on our customer company in the United States and build directly for them and with them, because we think that if we can just nail that for them, not only will they reinvest their capital over and over and over and over again, if we're the best place to put it, but also they will bring their friends, they will tell their private equity partners, and we will have no problem with the customer side of things. And that's exactly what we found so far. But it is really hard to turn away $15K a month of revenue or, whatever every other week when we're trying to reach for the stars and raise venture capital. So.
Yeah, I get it. I can definitely understand. And I think there's a quote by Steve Jobs. There's something he says along the lines of, focus is not so much about saying yes to certain things. It's about saying no to the right things. And you've got to be willing to say no, right? When great opportunities come along, that would make you money. That would bring in revenue. You could, seem kind of crazy to some people of like, why are you turning that down? That's property management. That's still like within your lane, right? You're like, no, like I am so laser focused on this, this mission, this goal of what we are doing that I've got to say no to this to have bigger yeses later on. And I think that'll pay dividends in the long term and building something that you are. How have you gone about hiring and bringing on talented people? Because it sounds like you even have mentioned a couple that have done successful things and already in their careers and, bringing them alongside what you're doing now. How have you gone about that hiring process?
Yeah, absolutely. So this is one of my favorite things to talk about. So we have an incredible team of people that, frankly, is really hard to build, particularly in this part of the country, in the Midwest. People who are filling these roles, the tech roles, the product roles, marketing in a specific way, and bringing on rock star operators. It's really, really hard to find around here. And one thing that I will pat Brad and myself on the back for is I think we've done an incredible job of attracting incredible talent. And the way that you do that is you aim for something that's 100 times bigger than what the next most crazy person is aiming for. And basically build something that people are proud to have on their chest, because it represents a dream, it represents a vision, it represents a better world for a lot of different parties. And I think that we're lucky to have the opportunity in such a large industry like this to really aim for the stars, and then bring people in and put them in the right role they really enjoy being in and that they're better than anybody else at. And that idea of rock stardom doesn't just stop with that one person. It's a network good in and of itself. Great people don't want to work with losers. They want to work with great people, which is frankly why our customers like us so much. Is we work very, very hard to vet our customer, to vet ourselves, and to continue to produce the best results for the best people who really understand what's going on. And that idea and that feeling, if you nail it, which I wouldn't say we've nailed it yet, but I believe going down that path, it's infectious and it's really powerful.
Mm-hmm. And your focus personally goes a long way too, right? When they see the division that you've got for yourself and some goals there personally, but also for the company and what you're trying to build, that goes such a long way in getting people excited and building that company culture, allowing them to want to work hard and want to help grow this vision that you have. That, I mean, there's something so huge there, and doing something unique and different, I think goes a long way as well. So for you and, your company, what is the growth? What does that look like over the next year, 5 years? I mean, where do you see the software going, your management, even personal portfolio? What are these next steps?
Yeah, absolutely. So just a little bit of background for listeners. Appreciate is about an $11 million company right now based on our last fundraising round. And we're growing about 22% month over month in revenue, somewhere in there. And so we've our biggest goal within VC, because you're playing a very different game than real estate within VC to a certain extent. It's all about growth. It's all about product. It's all about better serving customers as quickly as possible. Whereas, it's obviously a little bit different within real estate. So I see ourselves becoming a multi-billion-dollar company. We only need about 2% market penetration in this submarket in order to achieve that within the next 3 or 4 years. It takes about 20,000 units to get to $1 billion company at our current valuation metrics. And we've gone from 0 to 300 in really about 6 months, maybe 7 months. And since we've really, really, really doubled down into multifamily, we've grown about double as quickly. So I'm very excited to continue down this growth trajectory. Obviously, nobody really knows, right? But we're going into our seed round right now. So we've raised about $1 million, and we're about to raise another $1 million in our seed. And so that'll help us get to our Series A, which should take about a year after that. And basically, by the time we're raising Series A, we want to be in every major MSA in Missouri and be unequivocally the best option for our target customer in each location, and then raise that money to expand into the greater United States.
Absolutely. I could see it, right? You're solving a huge need in this market in multifamily that it's just not there. It's not a product that's available. So I absolutely know you can tap into that with what you're describing. Is this something that you want to be tied, your company wants to be tied with the operations of the management, always with the software, or are you all willing to license out that software to others to use in order to grow it even faster?
So yeah, we're not licensing. We're taking an equipment share approach. This is another choice that our VCs don't always love. Equipment share had kind of the same issues. Not everybody always loved it, but we believe that the tech we're building can give us the single best competitive advantage within this realm. And so if we can build the entire ecosystem that connects every player, including residents, and makes it almost guaranteed that we can take over a property and run it better than the last guy, then why would we give that out, because then the capital gains that are the true value are not really being captured. Because right now, even though we're not capturing any capital gains, and that's going directly to our owners, which is our full intention, but when that's going directly to our owners, why would we want that growth to be going to our potential operational competitors? If we could build the full stack top to bottom, so we have the full operational construction capabilities, full technology, and can give the best system to our owners, we may as well own it and capture it. It's a slower start, and frankly, it's more risky. But if we do nail it, then all of a sudden, nobody can ever compete with us or you if you work with us.
Exactly. You control it all, right? You haven't given this software, this technology out to the others. Like, you have to come to appreciate, and your management, to be able to, reap those benefits. So I think, like you said, maybe some more risk, maybe slightly slower in growing, because you've got to be a part of every deal, every property. But yeah, that long-term benefit, I think it's there. So I'm sure there is almost a time crunch though, of like getting this to market, and getting, as many owners on board with this as possible, and growing quickly, so that you don't miss out on, maybe somebody else that's putting together something similar. Is that ever a fear of like, hey, we've got to get this, pretty big quickly, because of a potential competition, or, just the time?
Yeah, I mean, of course, within venture, within tech, that's always a worry. The reason I'm less worried about it here is it takes a really, really weird and aggressively hopeful founding team to take down something like this. We have a really unique team where Brad is technical. He's built basically this company's approach in a tangential industry with very similar customer profiles, very similar marketing, very similar positioning, very similar in a lot of ways. And, I myself I am one of our customers. I am a very high growth multifamily investor. I understand what we're going for here. And it's really weird to find those two people in conjunction who have a similar vision of what they're building, and the ability to actually get it done, build a team, the relationships to get it done on all sides. And it's strange. And also our approach, while it is slower, and it is less horizontally scalable, meaning it's hard to get in every city in the nation tomorrow. It is much more vertically scalable, meaning it's very easy for us to work with private equity to, do a similar approach to what Equipment Share did, which they own a lot of the equipment that they rent out now, right? So they have a private equity play underneath the tech play. It's very easy for us to do a similar thing. So we can work with, the Lincolns of the world who want to put $400,000 into a fund to go buy an individual asset, and we can drive growth in a way that horizontal companies cannot without a private equity arm. And so again, it is slower, but if we do build the flywheel, it's incredibly powerful, and you build that entire ecosystem and nobody can ever compete. And so we've built most of the ecosystem, and we're growing very quickly. And obviously anything is fragile at this stage, but what I would say to anybody is please come compete with us, because the world would be a better place, but we're going to beat you. So
yeah, I love it. I love it. You got to have that competitive mindset, but also just know your value and what you're building, and the difficulty even to get where you've gotten today. And to somebody, like you said, being willing to hold out, not just license out some sort of similar technology, but, really finding that value and being the all-in-one package of the management alongside of the technology there. Is this something you see going, outside of the Midwest, nationwide? I mean, where do you see it being like a nationwide type of brand?
Yeah, so we do intend to be nationwide, and our long-term goal is regardless of where the capital lives, right? If you live in the Midwest, ideally you could invest with us anywhere, and it's just within your portfolio metrics and data, right? It becomes considerably easier to invest out of state if you have that command center that we're building. And so while we are trying to move geographically where we can, we're trying to focus even more geographically on the Midwest, because we believe that these types of assets, and this is another reason, by the way, nobody's going to come compete with us. Midwest is not sexy, and it's especially for tech, and it's exactly where this problem is, and it's exactly where the opportunity is. And so when we can go into Kansas City, Kansas, and buy rundown apartment complexes and turn them around with tech, actually brand them, get SEO, turn them into businesses, essentially. And then we can then have our capital partners potentially be dentists on the East Coast or wherever they're living, right? And we make it very easy to essentially manage the manager, manage the portfolio, acquisition, disposition, everything that you normally would need local relationships for, but we harbor those relationships. Then all of a sudden, geography matters a lot less for this asset class. In the same way that you can invest in a syndication that's investing in Texas, if you're from New York, it doesn't matter, right? Because it has the economy of scale. And at the end of the day, the only thing that matters is the asset being turned around. And so we believe that we can really unlock the geographical constraint, which is another huge value prop for us as we go, because theoretically that would compress cap rates on the asset that we manage as well, because the buyer pool on the other side would be considerably larger. So that's kind of our approach overall, and why we're focused very heavily geographically here. We do intend to be a national brand, but we're trying to be Midwest and Southwest and Southeast as quickly as we can, and then kind of reassess from there, because real estate trades differently in different cap rate areas.
Right. I mean, it makes plenty of sense because obviously this is where you're based out of to begin with, but the immense amount of opportunity that there is just in this region and being able to control things a little bit better, right? You said you can interact with people all over the country, but as far as the properties themselves and some of these things, there's tremendous opportunity here, Midwest, Southwest, Southeast, like you're saying. I'd like to go into kind of the final part of the show where we talk and ask the same 4 questions to each guest. So, Nick, these 4 here. First off, what is one of the best pieces of advice that you have been given?
I would say one of the best pieces of advice that I've been given that's kind of rang true for me is that usually the opportunity you've been looking for is about 2 steps further than you really want to take. So, there's a certain level of mental fortitude that you need in order to succeed within commercial real estate and tech. And every time that I've felt really, really, really downtrodden, like we're not going to get to the next step, and I've just decided to put my head down, lean into my team, lean into my co-founder, and just work, we've found massive, unforeseen potential, 2 or 3 steps away. And looking backwards at the 400 steps maybe I took before, in hindsight, that doesn't look like much, but generally the advice I've been given is that, opportunity is right behind the wall usually. So
that's really good. Yeah, I haven't heard that, but it makes a lot of sense that sometimes you have to take those next steps, take some risk, calculate a risk, and get into it before you're really going to know that opportunity. Number 2, what is one of your favorite business books?
I think Never Split the Difference by Chris Voss is one of my favorite business books. It's technically a negotiations book, but it's incredible. I've always been hyper focused on financial business books, and so for me that was a big comfort zone expander where it really dives deep into the psychology of negotiation and deals at the end of the day. And our job as multifamily investors is just being good at deals and negotiation. If you can't talk the car salesman down, you probably shouldn't be in this business. And so I think it's great approach to the business world from kind of a first principle standpoint.
Yeah. I love the book. Very insightful and person-to-person interaction and negotiation, sales, all those things that we utilize on the daily in business. Number 3, what is one character trait you notice that successful people commonly share?
So I'll let everybody in on a little secret. Our biggest hiring successes have come because our number one secret interview thing that we look for that we don't really tell our interviewees is we want somebody with a massive chip on the shoulder. If you don't have, kind of in line with my first answer for the initial question, if you don't have that chip on your shoulder, you're not going to push through that brick wall. You have to have a reason to think you're better than people or way worse than people. It doesn't really matter which side you're on, but you need to unreasonably be willing to continue pushing, because it has to be deeply tied to your ego. If your ego is not deeply tied to your success, then you're not going to be very successful and probably going to be a lot happier and healthier, but you're not going to be as successful. Mm-hmm. And so that's what we have found in our company as such an important hiring metric is you need to win. Mm-hmm. And it's been such a huge thing for us. And I've found that that's very common with real estate investors.
Yeah, I think that's huge and something that's understated, because there's got to be some serious motivation, something behind, a person showing up each and every day and to perform at their very best, right? Like you can foster, a lot of that with culture and motivation, but like somebody, people have got to have that in and of themselves. So I think that's a huge point there. Well, the fourth thing, where can people connect with you? And I would like to add, even if somebody is interested, in talking with you and maybe even working with Appreciate now or in the future, what's the best way to reach out and talk to you about these things?
Yeah, absolutely. So the best way to connect with me personally, I'm building up my Twitter, but it's not there yet, is probably LinkedIn. So it's just Nick Farquhar. Really, really simple / Nick Farquhar. There's not a whole lot of those, surprisingly. So pretty easy to find me there. And then as far as Appreciate goes, just send an email to founders@appreciate.io. If you're interested in working with us, what that can look like is either you have an asset to manage, you're looking to buy an asset, or you're looking to dispose of an asset, as we have a pretty big buyer pool. But it really comes down to being multifamily aligned and trying to either build or dispose of a portfolio there. And we can definitely help you out.
Great. Well, Nick, this has been solid. I am really excited about what you all are building, the value that you're providing there. And I don't know, it's neat seeing another young guy that is just going out, you're crushing it. And I definitely see this going a long ways, and, we'll definitely be watching. So I appreciate you coming on here.
Yeah, absolutely. Thanks so much, Lincoln. Great being on.
Definitely. Well, thank you all for tuning into this episode of the Growth Circle podcast. If you found value from it like I did, please leave a review, 5-star rating for us, and we will catch you on the next one.